Hello, everyone, and welcome to another episode of Selling Greenville, your favorite real estate podcast here in Greenville, South Carolina. I'm your host, as always, Stan McCune, realtor right here in Greenville. You can find all of my contact information in the show notes if you need a realtor in the Greenville area or outside the Greenville area, because I can refer you to others outside that are still within our network. Please find my contact information in the show notes. And if you enjoy this content, please subscribe to the show, like the show, rate if you can rate, review if you can review, comment, all of those good things that helps to get the show as much support as possible. So I'd appreciate if you guys could do that. And last but not least, this episode is sponsored by Piper Insurance Group. They are my go-to for home, auto, and umbrella insurance in South Carolina, in North Carolina, and Georgia. They're an independent insurance agency, so they can quote multiple different insurance companies and bring you the best possible rate, including on investment properties, flips, rentals, ground-up new construction, commercial properties, and the like. So please reach out to them. Their contact information is also in the show notes. I cannot recommend them highly enough to you guys. Please reach out to Piper Insurance Group today. You can talk directly to Stephen Piper, the man himself. He's a good guy, and he'll be able to help you out. And you know what? If he provides a free quote and you don't like it, just stick with your current carrier. All right. So this past week, job openings data came in, and it came in soft. In other words, there were fewer job openings than expected, higher layoff numbers than some people expected, and general numbers that don't bode well for the economy. Now, the data is what we call noisy. In other words, it's not clear. It's not just all straight up bad. Not all of the data is bad, but everyone's reading the tea leaves of this data and trying to figure out what's going on. And the general trend is that in general, the economy is showing weaker numbers than what it had a year ago. And it's been trending in that direction in general. And so people have been waiting for this for a long time. And of course, now we've got about half a year of data trending in this direction. And so immediately once the job openings data came out, the yield curve for the 2-year Treasury yield and the 10-year Treasury yield went from being inverted to being uninverted. Now, since then, the yield curve has reinverted, but it may go back and forth. That has happened in the past. Who knows? But I want to discuss this for a second without hopefully getting too in the weeds. And I'm going to, if you have no idea what I'm talking about with yield curves, I'm going to cover that here in just a second. I just want to say, for starters, I'm no economist. And I don't pretend to be one, but I track this stuff because it has massive implications for real estate. It also makes for a heck of good material for a podcast. So I think it's worth discussing what this means for the economy, but more specifically for the housing market. Now, I tell you guys from time to time, this is a Greenville real estate podcast, but this specific episode is kind of be more national because we're going to be talking more about some of the national data, but obviously it pertains to Greenville as well. But sometimes the national trends and the Greenville trends don't exactly mirror, so just keep that in mind. So before we go any further, let's talk about what the yield curve is and why we're even talking about inverted yield curves and uninverted yield curves and all these different things. So the short version of what this all means is this. When they're calculating the yield curve, they're taking the 10-year Treasury yield, which you can just Google right now and look up what number that is. It's probably going to be in the high threes, something like that. They'll take the 10-year Treasury yield, whatever that number is, and then divide that by whatever the 2-year Treasury yield number is. And if after dividing it, if the 10-year is higher than the 2-year, that is a normal yield curve. If the 2-year is above the 10-year, then that is an inverted yield curve. That's a very, very simplistic way to explain it. Let me explain it a different way. This is kind of a more dictionary definition, but essentially the yield curve is a graph that plots the interest rates, yields, of bonds having equal credit quality but different maturity dates. Normally, the yield curve slopes upward, meaning that the longer-term bonds, such as the 10-year, have higher yields than the short-term ones, such as the 2-year. That's because investors logically demand higher returns for tying up their money for a longer period. Okay, that should all hopefully make sense to you guys. Investors can choose to invest in the 10-year yield or the 2-year yield. If you're investing for a longer period of time, you want more money for your investment. That's a risk that's spread out for longer, and it's a greater risk. So the inverted yield curve is when this relationship flips. Short-term yields become higher than long-term yields. And as I've already said, the one that people track the most is if the 2-year bond has a higher yield than the 10-year bond. And basically, when it inverts and the 2-year is higher than the 10-year, that inversion suggests that investors expect future economic growth to slow down, which often leads to lower interest rates in the future. Okay? Again, I'm not going to get too far into the weeds on any of this. I'm just kind of giving you guys a broad overview. So one of the main reasons why an inversion occurs is there's an expectation of an economic downturn. So investors, for instance, might anticipate a recession or just an economic slowdown, and that prompts them to seek safety in long-term bonds, even at lower yields. So here's what happens. They flock to those longer-term bonds in order to find a quote-unquote safe investment, and they're willing to take it for cheaper than a 2-year yield because they are just looking for something that's going to be safe. And so this increased demand for long-term bonds drives their prices up and their yields down. Now, there are other things on the monetary policy side in terms of central banks raising short-term interest rates to combat inflation, things of that nature. That's also a possibility that can cause this inversion to happen. But generally speaking, it's the first option, and that's typically when people see an inverted yield curve, it's typically the result of traders speculating on where the economy is heading, and when the yield curve inverts, that's generally speaking a way for traders to say, we don't like what we see in the economy. Now, I've already said that briefly this past week, the yield curve uninverted. By the way, I'm recording this on September the 5th. I'm going to be gone. I have an extended weekend. I'm going to be gone out of town. And so I'm recording this a little early. So some of these numbers, if you're listening to this in the middle of September, some of these numbers might be a little bit different. Just keep that in mind. But the yield curve briefly uninverted, and it did reinvert. But that, again, that's not uncommon for that to happen. But it briefly uninverted, and immediately when that happened, the other day, headlines and sentiment on social media was immediately very confused. Many people think that the yield curve uninverting means that we are just back to normal, right? The inverted yield curve means that traders think we're going into a recession. So when it uninverts or disinverts, whichever, tomato, I'm going to say uninvert. When it uninverts, we're back to normal and a crisis has been averted. But historically, that's not actually the case. And the simple way to think about it is this. Are you betting that the short term or long term is going to be better economically? When investors are scared about the future, they bet on the short term. And when investors are scared about right now, the near term, then they bet on the long term. Well, here's the rub. Sometimes they are scared of both and essentially just pull money out of both and just invest in other things altogether rather than bonds and treasuries. And so when the yield curve inverts, it's generally because investors are, or I should say, when it uninverts, it can be the result of investors essentially just pulling money out altogether out of bonds and treasuries and kind of causing things to normalize. And when that happens, it's not normalizing because traders, investors think that things are okay. It's normalizing because they're just scared and they're just pivoting in terms of their investment strategy. Now, it can mean other things than that, but that's generally speaking what it means. And if you're watching on YouTube, I'm going to actually pull up a nice little chart for you guys to see. This chart shows yield curves from the past 40 years. Basically, there's a line at 0 if the graph is above 0, that's a standard. You could call it an uninverted yield curve. If it goes below 0, that's when the inversion happened. Now, one second here, I'm trying to pull things around so that I can actually see this. With painful accuracy, the uninversion of the yield curve. So when it goes from being inverted to uninverted, it has with painful precision preceded every single recession since 1955. So every recession that we've had in this country since 1955 has seen this yield curve invert before it then uninverts. And then when it uninverts is when you actually see the recession happen. So if you're looking at this chart, the grayed out areas, those are all the recessions that have happened. And the chart I'm showing you only goes back 40 years. But these are the recessions from the past 40 years. So you can see each time the yield curve inverted, but it wasn't until it uninverted that we went into recession. So we had that happen in the late 80s into the early 90s. Boom, recession. Early 2000s, it inverted, then uninverted. Boom, recession. 2007, 2008, it inverted. It bounced back and forth, inverted, uninverted, inverted again, then uninverted again in 2008. Boom, recession. COVID, same thing. It inverted right before COVID, then uninverted during COVID. Boom, recession. And so this is very accurate. Extremely, extremely accurate. And since this has been tracked, there's only been one time that we've had the yield curve invert and then uninvert, and there hasn't been a recession. But every time there has been a recession, this dynamic has happened. And so it's possible that there won't be a recession because, like I said, it happened one other time that this dynamic happened without a recession, but that is the exception, not the rule. So which narrative is right? Are we going back to normal? Are we entering into a recession? Well, as I've just alluded to, it's hard to know. The traditional metric that many people use to determine if we're in a recession or not is once we've had 2 consecutive quarters of negative GDP growth. But that's a lagging indicator. In other words, by the time we have the data indicating that we've had 2 consecutive quarters of negative GDP growth, then we'll already have been in the recession for 2 quarters. Of course, I like to get you guys ahead of the game. I don't want you guys to be looking at lagging data. Let's try to look ahead. Let's try to prognosticate what's happening. But the challenge of prognosticating all of that is that there's really a fair question of whether any of the old metrics that we've used for tracking the economy, for tracking the housing market and all of that, whether those old metrics even apply anymore since COVID. Obviously, the economy is fundamentally different since COVID, and we've talked about how many housing metrics we look at that can't really be compared to pre-COVID. For instance, months of inventory. That's one we've talked about quite a bit when we go over the market stats. Our months of inventory right now are historically very low, but it doesn't feel that, normally months inventory being in the low 3s where they are right now, that would be like a crazy seller's market. But it's not a crazy seller's market. It's kind of a soft seller's market. And so those are the sorts of things where it's like we're having to kind of adjust on the fly in terms of how we look at all of this data. Now, is that true of the economy as a whole? Or can we still trust the old metrics? For instance, the GDP rule. There's another rule called the SAM or SAM rule, SAHM. That would indicate that we are going into a recession. Economists are really split on this question. And since I'm not an economist, I'm certainly not going to try to weigh in on that question directly. But I do want to tease this out for a second without me going beyond what I'm capable of talking about. Let's think about what would the housing market look like if we went back into a recession? Because we talked about on the show before that not every recession is inherently a housing market recession. And actually, we have been in a housing market recession now for a couple of years without the broader economy being in a recession or without consensus believing that it is in a recession. So what's happening in the housing market doesn't always necessarily track with what's happening in the broader economy. Okay, so let's go back to that question. What would an actual recession in the economy look like for the housing market? Well, for starters, mortgage rates would likely come down substantially. In fact, in the wake of the job openings data that I referenced that caused briefly the uninversion in the yield curve, we immediately saw the 10-year Treasury yield fall below 3.8%, which has really been a tough line to break. Like the 10-year has not gone below 3.8 very much over the past 2 years. It fell below 2.8. Let me see where it's sitting at the moment that I'm recording this. It's currently sitting at 3.73, which is really low compared to what it has been the past couple of years. And as we talked about before, the 10-year Treasury yield correlates directly to mortgage rates, meaning that when the 10-year yield drops, typically mortgage rates drop with it. And that's exactly what we've seen. Mortgage rates have now come down. They're close to their the lowest that they've been the past 12 years. The lowest they've hit, not the past 12 years, 12 months. I believe the lowest, according to Mortgage News Daily, that they've been the past 12 months is 6.34. As of this recording, they're at 6.35. So they're hovering right near the 1 year low that we have seen for that specific number. And of course, if the economic situation seems dire enough to the Fed, they will start dropping rates as well. So these rates coming down are just a result of bond markets doing their thing with traders readjusting, reallocating on the fly. But once the Fed starts cutting rates as well, that will cause mortgage rates to drop a little bit as well. And so these are some of the things that we're looking at, okay? Now, rates dropping usually means a lot more demand in the housing market. But if rates are dropping because people are getting laid off, because the economy is in bad shape, because inflation's going crazy, all these things, then obviously it can cause the housing market to dip or to even crash, right? Even if rates are going down during this period of time. So my question is, which impacts the housing market more? Is it the economy as a whole, or is it mortgage rates? Well, I think that's an interesting question to ask, and I hope you guys think that's interesting too. And so I went about asking and trying to answer it this way. I took 3 data sets from the Federal Reserve: historical averages for the 30-year fixed rate mortgage, averages for for unemployment, and averages for inflation-adjusted housing prices. And I took that data and I analyzed it in a gazillion different ways to look for trends, and here is what I found. For starters, this is an easy one. So we'll start with something that you can comprehend very easily, and then we'll get into the weeds on some other things that won't be too complicated, but will be a little bit more to juggle. Okay, here's the easy one. Mortgage rates, when they are below 4%, that results in a seller's market almost regardless of what's happening in the economy. So now I'm not predicting that rates will do this, but in the examples where mortgage rates were ever below 4%, it kind of didn't really matter what unemployment was doing, what inflation was doing, what anything was doing. People buy houses in that environment. And so rates have for sure an outsized impact when mortgage rates are low. But what about unemployment? Well, let's look at all the different scenarios where mortgage rates were above 4%, right? Because I've already said when they're below 4%, it kind of doesn't matter what's happening in the economy. So let's look at the data set when they're above 4% and see where there seems to be a major breaking point in the unemployment data. So basically, how high does unemployment have to be for home prices to start to see a major impact? And I found that there are tiers to this. So the first tier is 3.9% unemployment. That's when we first start to see home prices being negatively impacted, kind of just across the board, in terms of not necessarily home prices coming down, but home prices not keeping up with inflation. So I guess you could say from an inflation-adjusted standpoint, they're coming down. But still, you would still consider it to be appreciating. It's just not at the same rate as inflation. So basically, this point, 3.9% unemployment, that's where we start to see home price appreciation start to slow down a bit. That being said, most of the data in that range for the times that we've had 3.9% unemployment would still be considered a seller's market. So we see an impact there, not a huge impact. Tier 2 is around 4.2% unemployment. I would classify Tier 2 as still a seller's market, but softer in terms of historically when unemployment has been in that 4.2% range. Now, we're currently sitting at around 4.3% unemployment, so this is where we are at. And this is exactly what it feels like. It feels like a soft seller's market. So right on point. The next tier is 4.9% unemployment. This is the point at which we usually start to see a buyer's market. And this is the point at which in the data, I start to see some old recessions in there. Data from around 2008, data from around 2000, data from around the late 80s, early 90s. Tier 4, 5.5% unemployment. And these are generally catastrophic numbers for the housing market. Full-blown housing recession numbers typically with a few random okay numbers sprinkled in, generally COVID related numbers, right? Because remember, unemployment went insane for a few months because we had a full economic shutdown. And so there's a few numbers in there that aren't catastrophic for the housing market, but those are more outliers. Once we get to 5.5% unemployment and mortgage rates are above 4%, that's usually really, really bad. And then tier 5, we see another big change, around 6.5% unemployment. And this is the point at which there's just no positives. All the numbers are bad. The housing market is in full-blown free fall typically at that level. And that is not what we want to see, generally speaking. Again, this is all of these tiers that I'm talking about are under the assumption that mortgage rates are above 4%, because as I've already said, below 4%, even if unemployment is at 6.5%, it's not going to have a negative impact on the housing market because there's going to be all sorts of money flooding into the housing market with rates at those levels. Okay, now what if we get now creative with the data and combine the 30-year fixed rate mortgage with the unemployment rate? So basically add them together. So if the 30-year fixed rate mortgage is 4% on average at the same time that the unemployment rate is 4% on average, then this number would be 8, right? 4 plus 4. Now, I'm not sure if anyone else has used this number before. I have no idea. If they have, my apologies. I haven't seen your work. I respect your game, but I haven't seen it. So I'm going to assume that nobody has, even though probably somebody out there has. But I'm going to give this a name because if I keep saying the 30-year fixed rate mortgage plus the unemployment rate, that's just too much. So I'm going to keep this simple and just call it the borrowing score, right? Because the higher the score, once you start adding to unemployment and the mortgage rate, the less likely people are able to borrow and buy houses. And the lower the score, the more likely they're able to borrow money towards purchasing houses, right? If unemployment and mortgage rates are low, it's going to be more capital in real estate, more real estate being purchased. If those numbers are both high, then there's going to be less money flowing into real estate. So looking at it from this standpoint, at what point do we start to see the real estate market majorly softening here? Well, the big shift that I noticed when I was analyzing this data occurred around an 11 borrowing score. So right now, the 30-year fixed rate mortgage is sitting at 6.35 and unemployment is sitting at 4.3. So you add those two numbers together and we're at 10.65. So if mortgage rates went back into the high sixes with unemployment where it is and likely getting worse, that would push us over the 11 borrowing score threshold, and that would be bad for the housing market. That would be particularly for sellers. For buyers, as long as you keep your job and you're not one of the 4.3% of people getting laid off, if you're a buyer, you might be okay with that. But again, that's assuming you keep your job and don't have a pay cut and all that kind of stuff. So where we're sitting right now at 10.65, we're below that threshold, but it wouldn't take much for us to go above that threshold. It could either take the unemployment rate going from 4.3 to 4.8, or it could take the 30-year fixed rate mortgage going from 6.35 to 6.7 while the unemployment rate stays where it is, or some combination of the two. And that would be, we would start to see a shift in the housing market if we cross that 11 threshold. Now, where we see a catastrophic shift is around 11.45. This is where market collapses tend to happen. And so if we saw unemployment start to really go up and mortgage rates didn't start to come down from where they are, then, and we started to get above 11 and started to approach that 11.45 number, that would be a problem for the housing market. So at the end of the day, does unemployment or do mortgage rates impact the housing market more? Here's my conclusion. Rates, they both impact the housing market, but rates impact it more. And the difference, honestly, is substantial. The mortgage rates versus the unemployment rate. The difference is substantial, with mortgage rates having a much more substantial impact on the housing market than the unemployment rate and the broader economy. So, for instance, I looked at when the borrowing score was near its highest point in all of the history of this data. And that was at or above 16, okay? There, in the entire sample that I was looking at, there were only 30 months that ever saw the borrowing score hit above 16. And most of those were between 1987 and 1992. There were also some during COVID. As I mentioned, unemployment went nuts during COVID. Now, for all of these examples, all 30 of these examples, except for one, the 30-year fixed-rate mortgage made up the majority of the borrowing score. For instance, September 1987, the 30-year fixed-rate mortgage was 10.63. Awful mortgage rates. I feel bad for loan officers back then. And the unemployment rate was 5.9. Also a really, really bad number, by the way. So that came out to 10.63, to 16.53 total. But of that, 10.63 was the 30-year fixed rate mortgage. So the mortgage rate made up about 65% of that total borrowing score. And home prices are dramatically lower in that scenario than in other scenarios when the mortgage rate makes up less than 50% of that score. How much lower are home prices, or I guess I should say, how much higher are home prices when the mortgage rate makes up less than 50% of that of the borrowing score? They're about 20 to 25% higher. So when you take that full score, that full borrowing score, and you determine whether the mortgage rate makes up greater than half of that score or less than half that score, that has a direct impact on the housing market by about 20 to 25%. If rates take up less than half of that score, prices tend to be about 20 to 25% higher than when rates are mortgage rates make up over half of that score, with everything else being equal. Okay, that's the important detail. Everything else being equal. You can't compare, a year that had, or a month that had a 16 borrowing score to a month that had a 9 borrowing score, right? That's not apples to apples. But I compared this apples to apples and came to this universal conclusion that that when the fixed rate mortgage made up less than or greater than half of the borrowing score, that really swung the housing market in one direction or the other. So to put a bow on that, the impact mortgage rates have on the housing market exceed the impact that the unemployment rate has by quite a bit. Although when you combine them together and get a high score, obviously it puts a damper on home prices regardless, unless the mortgage rate is 4% or below. So what does all this mean for the future? Let's prognosticate a little bit, or let's at least think about the future. And again, I want to mention this is national data, so it's hard to say precisely what it would mean for Greenville, but I think we can make a few general assumptions. First off, I think the Fed would start to get really uncomfortable if unemployment surpassed 5%. Historically, that has been kind of a tipping point for the past 3 recessions, not including COVID. COVID was the exception to all the rules. But in terms of the other past 3 recessions that we've had most recently, 5% is kind of when you see things start to snowball. And this is a concern. Generally, with unemployment data, you can't just turn off the spigot. Once layoffs start happening, they start to snowball. And so once we hit 5%, usually we get to 5.5%, 6% very, very quickly. And that's historically what has happened. And so I think if we got at or near 5% in the unemployment rate, I think that the Fed would start to get really uncomfortable, and at that point would probably start to make aggressive rate cuts that would then impact mortgage rates at that point. So until we get data indicating that unemployment is approaching those sorts of numbers, I think the Fed will still ease off rates, as we've talked about before, but will do so kind of more gradually. So I've already said Mortgage News Daily has rates currently at 6.35, and they've been kind of hovering in the mid 6.3s, low 6.4s for the past couple of weeks. I think by the beginning of next year, by the beginning of 2025, there's a good chance that those rates on Mortgage News Daily are at or near just 6, maybe even slightly below that, maybe in the high 5s. So unemployment would have to be at 5%, along with these mortgage rates to be at 6 to push us into that dreaded 11 borrowing score. But as I've already said, I think the Fed would really start to get aggressive on rate cutting if we got near 5% employment. So I really think that we're just going to keep hovering below that 11 borrowing score because, unless we see unemployment just suddenly take off super unexpectedly at a rate that it just hasn't, and the Fed gets way behind and doesn't ease off of rates quickly enough, then I just don't see a scenario where we could get to 11. That really is the only scenario where I could see us surpassing that 11 borrowing score. Additionally, remember, as mortgage rates come down and unemployment goes up, the percentage of the borrowing score will be shifted more heavily towards unemployment, which, as I've already discussed, is a positive for housing, as opposed to the current dynamic where the mortgage rate makes up most of the borrowing score. So long story short, I think for the time being, we're safe from a housing price collapse. I'm not saying that off of vibes. I'm saying that off of data. If you disagree with me, bring your data. Don't bring your vibes, because I'm not a vibes guy. I like the data. So what can we expect from here? From my reading of the data, as long as the borrowing score stays between 10 and 11, the market, I believe, is going to continue to essentially be the way it has been this year, with prices going up moderately, months of inventory in the mid to high 3s, and all of those things holding steady. This is, as I've already called it before, and what I like to call a soft seller's market. However, if we go into a recession where unemployment goes above 6, but mortgage rates go into or below the 4s, that would result in an insane seller's market. And as I've already said, rates at or below 4 trump everything else happening in the broader economy. And so at that point, we would just throw out the unemployment data. It doesn't matter. The housing market would go crazy. But I think that's pretty unlikely at this stage. Nobody should be banking on rates going at or below 4% at this point in the game. It would just be really shocking. The economy would have to deteriorate so much for the Fed to take action to drive rates that low. Now, what if the borrowing score goes below 10, which could happen if unemployment holds steady while mortgage rates go down? Then we'll see a big bump in demand. Okay, that's where we would start to really see this shifting from a soft seller's market into a standard seller's market. And I would say as well, even if the number kind of holds in the mid-10s where we are, but we start to see that unemployment number go up and the mortgage rate go down, I think we could get to the same place that way too. We could shift from a soft seller's market to a standard seller's market because, again, the outsized impact of mortgage rates on that number would become apparent at that point. By the way, this scenario is exactly what the Fed is hoping to do. Really, they're hoping to keep unemployment from getting too high. They're wanting to keep it kind of, I suspect they would love to see it stay just below 5 while slowly tapering down rates, the Fed funds rate, which then also impacts the mortgage rates. And so this is what they want to do. This is what they're trying to do. So I think we have to say that this is the most likely scenario. And this would push us from a soft seller's market into a more standard feeling seller's market. Not a crazy one, but just one where prices are going up, 4 to 5, 6% per year. Sellers are selling homes pretty quickly. Still a few months of inventory on the market, but buyers have to be aggressive in order to get homes. Now, if we see the score go below 9, the borrowing score go below 9, that's when things would start to get chaotic again and would start to feel like we're going right back into 2021 through 2022. For that to happen, mortgage rates would need to be in the low 5s at the highest, and the unemployment rate would have to come down a bit from where it's at now, right? It's at 4.3, so that would have to come down into 4 or below. Mortgage rates would have to come down to 5 or below. And again, is that possible? Yes. I don't see that happening until at the earliest 2026. Me personally, that would be very surprising if both those numbers came down. I think we're going to see unemployment creep up a bit. I think we're going to see mortgage rates come down a bit. And then, by 2026, perhaps at that point, we'll start to see the unemployment come down. And perhaps the Fed will feel comfortable keeping mortgage rates where they are at that point. And maybe they are around 5% at that point. We don't know. But that would be the most likely scenario where we would get to a 9 or below borrowing score. And I think the market would go bonkers at that point. And so, again, that's just 2 years from now. A lot can happen in the next 2 years. I mean, that's an eternity in real estate. But I'm just telling you guys all of the different scenarios and what I see. And so there you have it. Maybe we're going into recession, maybe not. Either way, going into recession doesn't inherently mean that the housing market will flip to some kind of crazy buyer's market. As we've already seen, we've been in a housing recession for a couple of years now. And on the contrary, it can have the opposite effect if the economy goes into recession, but mortgage rates start to come down. So we need to consider what mortgage rates are doing as part of the equation of what's happening with all of this, because they have an outsized impact on what's happening in the housing market, even when the economy is in the toilet. That's all for today's episode. I hope that was helpful for you guys. My contact information, as always, is in the show notes if you need a realtor in Greenville. Please like, rate, review, subscribe, all of those good things with the show. Reach out to Piper Insurance Group for a free quote today. They are also in the show notes, and we will talk again next time.